All right, welcome to this fifth panel, which is entitled Methods and Institutions. We have three presentations today. Now, as you'll notice, Eduardo and Jose are scheduled to present in your conference program. They couldn't make it to the conference, and so they are being replaced by Jordan Brennan. Just to introduce our panelists, we have first Jongchul Kim, who's a PhD student in political science at York University, and Jongchul is going to be presenting a paper entitled Trust and Power, and his research interests include goldsmith banking, early modern England political economy, and the ontology of money, I guess. We also have, to my left back here, Mike Lapointe, who will be presenting a paper called Power Dynamics and Institutional Change, New Avenues for Action Within Political Economic Institutions. And Mike's co-presenter, Nima, cannot be here with us today, so Mike will be presenting by himself. And his research interests are institutional change and neoliberalism in the EU. And finally, we have Jordan Brenner, who is a PhD student in the Department of Political Science at York University, and his paper is entitled, The Historical Specificity of the Crisis in Canada. And Jordan's dissertation focuses on the Canadian political economy and capital as power. So each presenter will get 20 minutes, and Jongchul, if you'd like to get us started, please.
This presentation, I'm trying to develop the ontology of early modern banking. This presentation grows from my previous two papers. The first paper is about the birth of private paper money. In this paper, I argue that the early modern banking is the institutionalization of the double ownership scheme known as trust. Trust here refers to the legal concept of trust, not the general abstract concept of trust. This paper is forthcoming in business history soon. And the second paper is about the evolution of private paper money into public currency. In this paper, I argue that this evolution required two events. First is the formation of a group person, the modern nation state and the business corporation. And second is the establishment of these group persons' indebtedness to their constitution. I present this paper in the Philadelphia. From these two papers, today's presentation is grow. So probably if you're not familiar with my previous two papers, probably you'd feel that my presentation jumped from the nowhere. So if you're interested in my paper, previous paper, please email me. I can return my two papers. The present literature on the ontology of money largely focuses on the nature and origin of money in general, and ignore the historical specificity of the modern credit money. Two main research themes of the literature demonstrate this focus. The first theme is the relationship between the value and money, especially whether the semiotic value attached to the certain objects, such as gold and silver, correspond to the object's essential property, or whether the value has been attributed to these objects by a human collective mind. The second theme is a question of whether money is a commodity or the debt claim. These two themes are applicable to all forms of money, ancient or modern. Modern money is comprised of national paper money and the bank note issued by private commercial bank. The later money that is convertible into the former, but at the same time, the later is credit money because its issuance is an additional creation of money in the form of credit. This money creation by private commercial bank differentiates modern credit money from the pre-modern money. In this discussion of ontology of modern credit money, I examined how concept of trust, person, property, and presentation has evolved, and how they explain the origin and evolution of modern credit money in early modern England. So I set up the 5 theses. First thesis is that trust and modern banking in early modern England are a combination between the permanent indebtedness and permanent identity. Second thesis is that two double ownership scheme presuppose and develop the specific concept of property and person and the specific relationship between the two. Third thesis is that the conceptualization of early modern banking as trust explain the importance of a function of store value in the origin of modern credit money. First is trust and modern banking in earlier modern England presuppose the idea of representation. 5 is that early modern credit money is a fraudulent creation of additional title and claim to the same fund. Real owners are hidden in law, escaping from any responsibility for the use of money deposited. Due to the time limitation, I focus on second thesis about the person and the property. The London goldsmith banking grew from the traditional deposit transaction that provide a safekeeping business service to the depositor. The epoch-making innovation that found modern banking occurred when some ingenious goldsmith banker issued deposit receipt to those who came to borrow them. The figure below describe a different distance between the person and property in 3 deposit transactions. In the traditional regular, irregular deposit transaction, A and B, regular is a non-fungible thing, irregular means a fungible thing, is homogeneous. In 2 first deposit transaction, a specific depositor maintain ownership to a specific property or to a part of a pool of property. And there is no separation between the property owner person and deposited property. Traditional deposit transaction primarily aim to keep property safely. A depository has a charge a safekeeping fee to the depositor. There has been long moral and legal debate as to whether depositories attempt to utilize deposited funds for their profit constitute a crime. These attempts were regarded as an embezzlement. In the strict Roman law tradition, an honest depository of fungible things such as money and grain have to keep 100% tandem them of the deposit in order to honor the right of a depositor to withdraw the deposit at any time on demand. But in the modern banking in earlier modern England, as shown in the as you can see this last figure, the separation between the property owner person and deposited property occurred, but at the same time, connection between two maintained. Intrinsically, modern deposit banking in early modern England was a hybrid between deposit transaction and loan transaction. It was a deposit transaction like B and C, in which the right of a depositor were right in rem, the right against the thing, because the demanded clause of the banknote allowed their holder to practically retain the ownership of a fund deposited in the bank's vault. Thus, as long as early modern banking was a deposit transaction, there was no separation between the person and property. But at the same time, modern banking in early modern England was a loan transaction in which right of a depositor are right of against the person, right in personam. And the depositor cede legal ownership of property to depository, and in exchange, depositor obtain a debt claim that goes against the person. The depositor could oblige the debtor to fulfill the obligation to repay a principal and interest. But depositor did not concern how the depositor used the deposit fund and did not bear any responsibility for the result of use. Thus, as long as modern banking is a loan transaction, the separation occurred. Also, the other and banknotes of Goldsmith Banker and the Bank of England use a bearer clause and circulate freely outside of client of bank. To use bearer clause in their note, the bank practically declare an equal manner to any holder. By using bearer clause, Goldsmith Bank and the Bank of England intended to make a contract with the anonymous person in the community who hold the banker's note. That is, the banker was not really concerned who was a specific holder of the notes, because a change of holder did not change the banker's obligation. As is in the figure below, contract counterpart of the banker from standpoint of a banker was not the specific person A, B, C, or D, but the abstract person who exists during the whole period of transfer from A to B and from B to C and from C to D. This abstract person was represented by the specific holder A, B, C, D. Banker loan deposit fund to the industrialist and merchant in the name and discretion of the bankers. In return, the borrowers invest the fund into various forms of property. What the banker expected from the borrower was only the return of the principal with the interest. Thus, in early modern banking, the relations between property owner person and property was between person and abstract on the one hand, and property in abstract value on the other. In contrast, in case of regular and irregular deposit transaction, the bearer clause of deposit certificate, which allowed the certificate to circulate freely outside of the circle of the depositor, was not attractive to 100% reserve deposit service. The depository would not know who the current holder of the certificate, and resultantly, the depository hardly collect the storage fee that was the main source of profit for the depository. Therefore, the ownership of irregular and regular deposit remain to specific owner, and the private investment of the deposit fund in the name and discretion of the depository, as mentioned, was not morally and legally forbidden. Thus, unlike early modern banking, the ownership of the specific thing or part of a pool of thing is fixed to the specific person. Actually, the idea of property was peculiar to Western civilization, especially to England. The term property itself demonstrates this peculiarity. Property in all major European languages is used in two related senses. That which is an attribute or someone or something, and that which belongs to the someone. And this usage of property tends to equate the attribute of someone with the thing owned by someone. So liberty, body, things, all property. This equation has two possibilities of conceptualizing property. One is treat attribute of person, including labor, body, and liberty, as things that the person can own and that are like a tangible thing, separable from the person and transferable to the other person. This is a propertyization of the attribute of a human being, as I call. The other possibility is treat the right to possess thing as a natural or birth, regardless of social consensus of custom. The right of possess thing is the same as the right to possess the natural attribute of human being. The right exists prior to establishment of social institution or consensus. This is I call a propertyization of a thing. These two propertyization occurred in early modern England. what remains after turning all the attributes of the person into property that the person owned is an abstract subject who retained its identity as owner of the property. In doing so, the idea of property contributes to generating modern ideology of human equality. Every person as an abstract is equal before law. Property, attribute, and thing make a human being differ from each other. Modern law, however, considers human beings as separate from their property, and in so doing, treat them as the same, equal to each other. It is a concept of person in the modern law. Furthermore, modern law defines the relationship between the person and property as that of ownership. Person in abstract is formulated as the owner of the property. This formula of personal property is the basis of modern ideology of human right. Human beings are persons are equally born to have a right to possess property, liberty, and freedom. This process of separation and reformulation developed as an important political project in 17th century England, the same period when modern credit money and trust originate. The term property at the time underwent a metamorphosis, revolutionary in its implication, by being broadened to the mean not only material object, but everything which an individual had a natural right to claim as his own. So in the 17th century England, a radical leveler insists that the natural birth, all men equal and alike born to like property, liberty, and freedom. John Locke is a representative for this two propertization of thing and attribute of human being. So actually, many postmodernists actually criticize this idea of person. The idea of person imply the personal identity unchanging in spite of his or her obviously unchanging, undergoing change through time. Whitehead criticized this idea of person and then argued that the idea of personality comes from the first conception that reality has the same structure of a language. Our language take a form of a subject and predicate. When we think that reality has the same structure of a subject and predicate, we separate the subject from predicate, or doer from the doing. This critique of a ideal person also made by Nietzsche. Nietzsche argued that there is no doer separate from the doing. This ideal person has an ethical implication. The ideal personal identity assumes the continuity and preservation of the self. This continuity accumulates all the past happenings, including sinful acts, and prevent any salvation before the end of continuity. The credit culture of early modern England that punished strictly and expelled the bankrupt out of society seemed to reflect this idea of personal identity. In contrast to the early modern England, many ancient communities held a different idea of self. In this community, self was conceptualized as a circular, that the self was destroyed and newborn every year. The cyclic abolition of a self accompanied cyclic abolition of the past and the sin and guilt, which the past inevitably entailed. Before modern time, the debt was cancelled by the emperor in a periodic redemption or year of jubilation. This normally occurred in the 30th year of his reign or upon his death, when a new emperor began with the clean state. This cancellation of debt every 30 years in modern time would fundamentally threaten the stability of credit-debt social relation and the modern credit economy. To carry the credit-debt relation without communal cancellation, however, is a nearly impossible task. Far from the assumption of rationality by the neoclassical economy, human beings are not rational enough to avoid generating untrustworthy debts, which cannot carry out their repayment obligation and thus add instability to the credit economy. When modern society no longer gives periodic forgiveness to such a debt by communal events, it should clear them forcefully throughout the periodic economic crisis. This economic crisis generates high costs for third parties who are not innocently involved in the transaction of credit money, including workers, supplier, and consumer. But the periodic forgiveness in modern time is unethical as well, because the most big debtors are the ruling class who are the privately benefit by the previous economic boom. Yep. Yeah. It is my part of research on ontology of modern money. So if you're interested in that whole, my article paper, please email me. I can return my paper. Thank you.
Perfect timing. We'll go on to Mike Lapointe's paper, which is entitled Power Dynamics and Institutional Change. Go ahead, Mike.
Okay. Obviously, the title of the presentation is different than what was on the abstract, but that is just part of the theme of the presentation, I suppose. Today, I'm probably the least economically oriented and probably the least developed research project. I actually just graduated yesterday from my master's program at Western, so I have a long way to go with this. Basically, for my master's paper, I studied the varieties of capitalism literature, which talks about the institutional complementarities that differentiate between coordinated and liberal market economies. And what I noticed was that Holland Soskis's work in 2001 really didn't talk too much about institutional change, and it's actually been criticized on that a number of times. What I also noticed is that the processes of European integration are not particularly well delineated in terms of their effects on national economic models. So basically, I'm interested in finding out what the effects of these processes are on these national economic models. So if we look at the actual processes of European integration since the 1980s, obviously there has been a particularly strong neoliberal bias, and I'm indebted to Mr. Hager over here because I've read much of his work, as well as Bastian van Apeldoorn and his work on this. So obviously, in terms of post-Fordism, I think it's best described as an economic regime characterized by pretty significant government regulation, relatively well-developed welfare state institutions, significant financial oversight, et cetera, et cetera. But at the end of the 70s, the European integration process hit a snag, and there was a period of Euroscepticism. And so obviously there was a supranational and a national desire to reinvigorate the European integration process. But what's interesting is that there were a number of different ways in which this could have occurred. There was the possibilities for reinvigorating supranational social democracy, where where European policymakers could consolidate the European social model throughout the member states. There was another paradigm that called for neo-mercantilism, where higher tariffs and higher protection of European industries would be facilitated. And of course, there was neoliberalism. And so I think the latter is the one that won out, and that was reflected in Maastricht and in Lisbon. So obviously, the role of the European Roundtable of Industrialists is fairly well documented in this literature. They are essentially a lobby group who are characterized by the leading corporations within Europe. And their recommendations were liberalization of markets, basically basically a very strong neoliberal bias. Now, as you can see, this was from their 2010 report. It looks to facilitate an ongoing dialogue with national policymakers in order to provide recommendations on what the best way that markets can thrive. And they have taken note of the 2008 financial crisis, and they have provided a few recommendations. Now, what's interesting is that these recommendations aren't particularly different from what they were before. They're not in favor of significant regulation, and they're in favor of continued consolidation of competition policy. So although initially there were divisions within this group, I think now it's pretty clear that the neoliberal side has won out, and their advice has been strongly implemented within the European integration process. So this speaks to institutions because it speaks to institutional design, and I think analyzing the role of these elites is of particular importance here. And as I said, it's still a relatively undeveloped research program, but I think that is a good place to start. The other process that I wanted to explore has to do with the distinctions between negative versus positive integration. And this has very much to do with judicial policy rather than legislative policy. And so I think here the distinction between policy formulation and policy implementation is very important to take note of. I think the latter, there's an argument that the latter has largely fallen under the auspices of legal rather than political actors, and I'll explain why that is. Suzanne Schmidt, who writes about negative integration and legal uncertainty, she points out that much of the previous literature analyzing European integration fails to take the less explicit or the less manifest changes within domestic systems into account, because it, quote, overly concentrates on the implementation of directives and neglects the lessons to be learned by distinguishing between positive and negative integration. So again, from a research perspective, I think that this distinction is quite interesting. She addresses the role of legal uncertainty and the opportunity structures that arise from that. So although it's clear that Europe's supranational bodies continue to be responsible for delineating overall European legislation, as well as establishing the general parameters of the integration process, the dynamics of judicial making are involved, or basically they speak to the fact that European obligations on member states are often very, very far from clear. And because it is the responsibility of individual states to implement these obligations, often they have to devise domestic policies in the absence of any particular certainty as to what these obligations are. And of course, who are the ones who take advantage of this? I believe there's an argument that transnational financial actors, through national courts and through the European Court, are particularly well suited or are particularly inclined to use legal integration to facilitate neoliberal market integration. So, I mean, it's often much easier to attain goals through legal rather than political channels, given domestic interest constellations, given institutional configurations within less liberal economies, et cetera, et cetera. So basically, the European process has really become a reality whose hard law constraints are increasingly felt in the economic, social, and personal lives of citizens rather than just in the purely economic sphere. And neoliberals perhaps won't be as upfront about that as, as they should be. So, excuse me. So in terms of returning back to the varieties of capitalism literature, which demonstrates the fundamental linkages between various political economic institutions, the authors Hall and Soskis were definitely correct in pointing out how institutional orientations provided national economies with a comparative institutional advantage. And in this case, I studied Germany, and Germany has a comparative institutional advantage over the UK, for example, in terms of heavy manufacturing, but not in terms of financial speculation. what these authors missed, and this is part of my master's paper, I suppose, is that many of the European court's decisions are actually undermining these institutional foundations on which these comparative advantages exist. Within the theme of this conference, I suppose, the liberal transformation that is occurring within the European Union is not so much happening from the pressures of market competition as they are happening under legal compulsion of European courts' jurisprudence. And feel free to criticize me on that point, but that's my feeling. So in terms of institutionalist theory, which I saved to the end, I think that institutional theory is particularly well suited to study the European Union due to the inadequacy of neo-functionalism and intergovernmentalism. Institutionalist theory has the ability to transcend these more traditional approaches. Basically, I don't think, and other academics don't think that these two approaches can facilitate testable hypotheses regarding the conditions under which supranational institutions exert an independent causal influence on the process of European integration and on the process of institutional change within national economies. So, for example, in terms of rational choice institutionalism, this approach posits, obviously, I know most of you are probably familiar with this, but institutions are established to reduce transaction costs and to overcome collective action problems. However, I think by itself, rational choice tends to assume that the process of institutional creation is a highly purposive one, which is largely under the control of actors who know exactly what they're doing. I think the legal uncertainty and the opportunity structures that I spoke about was not unanticipated, but it wasn't explicit in their plans during the facilitation of European integration. So, although rational choice is very good at establishing institutional origins, I don't think it's very good at talking about institutional change. I think historical institutionalism is better for this, as it takes uneven asymmetric power relations into account, and it speaks very much to why national economic and political models are distinctive, and why these institutions structure conflict to privilege some interests while demobilizing other interests. And of course, historical institutionalism is defined by path dependency and critical junctures. But I think given the nature, in my brief experience with the European integration process, I think that the relaunch of it in the 1980s isn't so much a path-dependent phenomenon as it can be understood as a critical juncture in the way that the European Union operated. Now, I believe that path dependency can be used again in the second half of the European integration process to explain how the legal sphere operates in the way that it does. Although both of these varieties are well tested and well established, I think in combination they will be able to constitute an adequate theory of European integration. So that is my research interest. So if there are any suggestions. The lessons that I think that I would like to guide my future research is that there must be a distinction between market making and market shaping, because they are two very different processes. In terms of the institutionalist paradigm, I think that it is not adequate in the way that it stands now, but there is certainly a lot of potential there. And in terms of the varieties of capitalism, which I'll finish up with, the one major argument within that school is that, or the major question is whether or not we are seeing continued distinctiveness between national economic models, or whether we are seeing a convergence into a more comprehensive liberal program. And Hall and Soskis have argued that the institutions that exist within coordinated market economies will continue to facilitate divergence between liberal and coordinated market models. I think that the European integration process speaks against that hypothesis. And I think that there is a case to be made that we are seeing liberal convergence, especially given the fact that not a whole lot has changed following this financial crisis. And the European Central Bank, for example, is finding itself in a situation that it wasn't meant to be in. It wasn't meant to be buying bonds in the volume that it is, for example. So I think the European Union is adapting to this crisis, but I think it is happening in a liberal sort of way. If there are, again, any suggestions or any criticisms of all of this, I know it's kind of really an unshaped paradigm at this point, but I think that there is something to be said for this. So that's all I have to say.
Thanks, Mike. Once again, very good timing. You only used about 15 of your minutes. That doesn't give you the right to take the 5. But Jordan Brennan is now our next presenter, and he's going to be presenting a paper called The Historical Specificity of the Crisis in Canada. So, Jordan, 20 minutes.
Thanks, Sandy. Okay. People tend to look for that which they wish to see. This is the first time I've consciously experienced a political economic crisis, but so far, what I've seen is people searching for answers in light of their theoretical and political predispositions. So it's true, Alan Greenspan sat in front of a congressional panel and basically said his faith in deregulation was shaken, but I think he is far from the norm. The Financial Times people as well, I think they're pretty honest. They say that their paradigm is broken, and I believe that they believe that, but they are not necessarily the norm. Here in Canada, the fervently free market Fraser Institute wasted no time in doling out the blame for the crisis. They said the following: the financial crisis isn't the result of greed or deregulation. Rather, banks, borrowers, and investors simply acted rationally in their own self-interest, following a set of rules created by poor government policy. Ultimately, the market is still the best way to prevent and respond to government failure. Now, there are those who are more critical of neoliberal dogma. Some people attribute the crisis to a breakdown of regulation. Barry Eichengreen, I think, falls into this camp. Some people point to financial excess, and George Soros is an example. And some people look at the excess debt and shortage of demand, and Paul Krugman, I think, is in this category. Now, the Marxists, for a century and a half, have been looking for their masters' apocalyptic prophecies to be fulfilled, and so certainly they're not going to waste this crisis as an opportunity to point out that their masters' predictions are still highly relevant and still totally valid. So what I'm basically saying here is that these things shouldn't surprise us. Each framework, neoclassical, Keynesian, Marxist, comes equipped with its own set of tools in the form of assumptions, implicit and explicit assumptions, concepts and measurements. And these tools in turn condition the questions that get asked and ultimately where answers are sought. Now, in the capitalist power framework, the paramount object of the political economy is dominant capital, and the central process is differential accumulation. Now, yet to date, Nitzan and Bickler have released 4 papers on the current crisis, and not one of them has dealt with dominant capital or differential accumulation. But if, as they claim, this is a crisis unlike others, then one would expect that there would be a crisis for the paramount object, dominant capital, and a crisis for the central process, differential accumulation. So that was sort of the background to my 3-week foray into the crisis in Canada. I'm going to begin by just talking a bit about the measure of crisis, how it's been conceptualized, and then look at the Canadian equity market in context. I'm then going to briefly recount how the different frameworks have diagnosed the crisis, and from there get into capitalist power, specifically focusing on the regimes of differential accumulation and the importance that deflation plays in this framework, and then, of course, looking at dominant capital and differential accumulation in Canada. And then in the end, I'm just going to speculate a bit about why the fear amongst the investors and the ruling elites. To begin, the current crisis has engendered all types of shortages, tax revenues, commercial lending, industrial output, food production, etc. But there is one thing there is no shortage of, and that is grand pronouncements and rhetorical questions. So the Financial Post of Toronto ran a headline story entitled "Saving Private Enterprise." Joe Stiglitz published a piece in the Globe and Mail, another Toronto national, in which he said, neoliberalism is basically over. So this type of comments suggest that most of the intelligentsia or influential people aren't viewing this as a garden variety recession, but they think this is somehow a transformational event. But my sort of questioning and my line of thinking was just, if this is transformational, scholars, people like Barry Eichengreen, are measuring this crisis in very sort of simple ways. They're looking at things like industrial output, the volume of world trade, equity markets, and so on. And so they're looking how much have these measures fallen, how quickly have they fallen, and how wide is the crisis spread over the planet. So they're looking at breadth, depth, and velocity. And it's still too soon to speak of duration. But is that all that is specific about this crisis? Is that we've seen falls or changes in these measures? Eichengreen and O'Rourke, in their papers in 2009 and 2010, draw a number of ominous parallels between 1929 and 2007. And they claim that this current crisis has all the earmarks of a depression. That if we compare measures in the 2 years, 1929 2007, we see parallels on a number of levels. And save for government intervention in terms of budget deficits, central bank discount rates, and money supply, and so on, we would have seen a much, much deeper crisis. So governments basically prevented this from being a real Great Depression. That's their claim. Now, so what does this mean for Canada? What's happened in Canada so far? The recession hit Canada in October of 2008, and that's actually the same month that the Washington Post released an article saying how the global crisis had largely bypassed Canada. So there might have been some embarrassment about that. But the sort of general wisdom on this is that the crisis hit Canada less severely than other parts of the world in terms of familiar statistics on industrial output and trade and so on. Now, I hadn't known about Alan Watts' research, but my understanding was that this was not really centering on a banking crisis. There was no large-scale bank failure in Canada. we've learned today that there's a bank bailout, but there was no large-scale bank failure. And so Canada sort of emerged from this as having a very strong banking and financial sector. When we compare the loss in stock market value, this is what Figure 1 shows us. Canada indeed came out relatively mild. I mean, it still lost nearly half its value. It lost 44% from its peak, compared to 55% in the US and 58% in the world. But the rebound and the recovery has been less impressive. Canada's market has rebounded only 68%, while the world, for instance, has rebounded 86%. Now, that's how Canada stacks up to the world. How does it compare to Canada over time? How deep is this crisis in contrast to, say, the tech wreck in 2000, the recessions of 90 and 81 and 73? Well, in this chart here, Figure 2, what I show you is the depth of this crisis. Sorry, the thick black line is Canada, and that's the total value of equity markets mapped on a logarithmic scale. And what we see is the 2007 crisis is indeed the deepest. I couldn't get data going back to the Great Depression, so I can't talk about the post-war era, but this seems to be a good enough historical picture. This sort of corroborates the story that this is the deepest crisis Canada or the world has indeed faced since the Great Depression, and it's matched or mirrored closely by the tech wreck in 2000, and it surpasses the crisis of 73, of 81, and 1990. So far the story stacks up and makes sense. And this shows us Canada's relative decline compared both to the world and the US and then compared to itself. Now, I wanted to know though, is there anything that's unique or unprecedented about this crisis? Is this just the case that these measures fell very quickly, they fell very fast? Is there not something else that would be unique that would set this crisis apart? if it is indeed, as Nitz and Bickler claim, a crisis like the Great Depression, in which this is systemic and it's potentially going to lead to political transformation in some sense, then one would expect that it's not just a question of these measures of depth and so on. So I started looking at basic macro picture to see if there's anything unique about this crisis. And what I came to, and this is perhaps well known to everybody, was not well known to me, here in figure 3, what I'm contrasting is inflation and the unemployment rate in Canada, and the inflation is measured by the Consumer Price Index. And what I've plotted, inflation is on the y-axis, the unemployment rate is on the x-axis, and what I've plotted is the crisis, or the duration of the crisis in 1973, 1981, 1990, 2000, and 2008. And so we can see the relative measures in terms of inflation and unemployment. Now, there's certainly no clear pattern that emerges here. Some crises are inflationary, some are disinflationary. The one unique feature about the current crisis is the existence of deflation. That is something that sets this crisis apart, makes it in some sense unique. People talk about Great Depression and how this is like a depression, but in terms of unemployment, it's quite mild actually. I mean, we're only at something like a peak of 9 or 9%, whereas the crisis of 1990, 1981 was much, much deeper. So, but this still stands out to my mind as something that is unique about this crisis. So how do we explain this? How is this explained? I will very, very briefly go through how this crisis has been diagnosed by the other frameworks, beginning with the neoclassicists. They see this as having two dimensions. So there is a real recession in the form of unemployment, idle productive capacity, and the result of lack of demand and so on. And then there's this financial crisis, which exacerbated the real recession. So you get this dual crisis, which makes it not just a recession, but a great recession. The neoclassical sort of background thinking is, of course, that the system is an equilibrium-seeking system, and it can regulate itself automatically through the price mechanism. And then the government has additional stabilization mechanisms in the form of unemployment and social assistance and so on. The Keynesians, I'm going to skip ahead because I feel like everyone probably knows this and is familiar with it. The Keynesians, of course, are different in that major precept, that they don't tend to think of it as an equilibrium-seeking system. It could be otherwise. And so the relevance of Hyman Minsky's ideas and the financial instability hypothesis has come very much into vogue recently. And Alan actually summarized a bit about the financial instability hypothesis. What I'll just say, again, is that there were three classes of debt. There is very safe debt in the form of what's called hedged debt. There is speculative debt and Ponzi debt. And so you move from less risky to more risky forms of debt. And that's how some people have characterized this crisis, is that investors thought they were holding hedge and speculative debt. They thought they were holding safe debt, and when in fact they were holding speculative and Ponzi debt. And so this is a breakdown in risk management. And the C.D. Howe Institute in Canada, which is a major think tank, basically attributed the crisis to that. Investors got confused with the quality of their debt, and that's what led to this, this crash. And then there's, of course, the Marxists, and I was going to summarize a bit about the monopoly school and how they sort of approach this crisis, but again, it's probably really well known already, so I won't bother with that. Capitalist power, of course, is different and trying to be different consciously so. Nitzen and Bickler claim, for those of you who missed yesterday, that the correlation between price and earnings per share on the S&P 500 is highly significant, for it indicates that the forward-looking ritual of modern finance is broken down, and we see investors now adopting the backward-looking posture of pre-modern finance, and this suggests breakdown of the dominant ideology and systemic fear amongst the ruling class. I'm curious why they didn't touch on dominant capital and differential accumulation. If this is sort of the central process and so on, why was not built into the research? And so that's where I went searching in the Canadian context. I wanted to know if there's anything significant happening at that level. Now, before I mention what sort of happened on that dimension, I'll just recount for you, for some of you probably will not know, that in their 2009 book, Capitalist Power, Nixon and Bickler claim that the political economy is driven by dominant capital striving to beat some benchmark, striving to beat an average, and so differentially accumulating. And they outline 4 broad pathways available to dominant capital to differentially accumulate, and they label them breadth and depth. And then it's broken down into an internal and external dimension, so there's a 4-way taxonomy. Greenfield investment, or external breadth, is one. Mergers and acquisitions, or internal breadth, is a second. Stagflation, which they label external depth, and cost cutting, or internal depth. These are the 4 regimes of differential accumulation. One of the key claims they make on the basis of this taxonomy is that cost cutting and greenfield investments will only allow dominant capital to meet rather than beat the average. As a historical claim, that has been the case. And whereas mergers and acquisitions, so internal breadth, and stagflation, external depth, enable dominant capital to beat the average, to differentially accumulate. And so these are the 2 main engines of differential accumulation, and over the long haul, mergers and acquisitions is the most stable, or the most commonly used route. Now, I think the crisis and the existence of deflation actually serves as a test of their claims and some of the central claims in their book. Because they claim that depth and breadth move inversely to one another, historically speaking. Thanks, Sandy. My understanding here, and I'm going to be on sort of maybe unstable ground because I don't have the evidence to show you or to back up the claims, but my understanding is obviously stagflation requires inflation as a matter of definition. Now, the 20th century is replete with cases, wild swings in prices, inflation and disinflation, but in the post-war era, deflation actually is not very common. I mean, in the Canadian experience, it's almost unprecedented, and I think most people, especially the central bankers, think of deflation as a relic of the past, of the pre-war past, prior to central banks and so on. And especially since the 1970s and the rise of monetarism, my understanding is central bankers don't fear inflation very much, if at all. But the existence of deflation in the current crisis would be highly significant then, and historically specific. So my question is, if mergers and acquisitions aren't picking up, and if there is no stagflation, then we would expect dominant capital to fail to beat the average. It differentially decumulates. This is a testable hypothesis, and again, I'm on shaky ground because I don't have all the evidence to support this. But this, in fact, is the case. In Figure 4, and this is data pertaining to Canada, you see you see dominant capital fail to beat the average. What you have here is the thick black line represents the differential capitalization of Canada's largest firms. So it's the average of the top 60 firms divided by the average of the entire Toronto Stock Exchange. And that ratio signals differential capitalization. I do the same thing for net profit. And this data goes back to the late 1960s. So we actually have a historical picture that sort of is pertaining to the time period I'm looking at. It's true that in 2000 or 2001, the tech wreck, there is differential decumulation for dominant capital, but it's very slight comparatively, and it's driven by one single firm, and that's Nortel Networks. That's what accounts for, you can see right here, this deep cavity in net profit and the slight cavity in differential capitalization. What you see, though, in the current crisis is a coordinated and synchronized decline of both measures, and that is unprecedented. By both measures, they failed to beat the average, and if you look at the other crises of 1990, 1981, and even the early 1970s, that does not exist, and that is unprecedented. So how does this connect with inflation, or deflation, or disinflation? What I've done in Figure 5 is I've broken down differential accumulation into simply differential capitalization. I've condensed the time scale, and I'm looking at monthly data now. And so I've got monthly data contrasting differential capitalization and inflation as measured by the Consumer Price Index. And I've smoothed both measures, and there's a time lag here. But what has happened is we see that the differential deaccumulation follows disinflation and actually deflation. dominant capital is failing to beat the average. So even though in figure 1, I'll just scoop back up there for a second, figure 1, there looks like there have been a tremendous rebound since the middle of 2009. In absolute terms, prices are rising. We should be out of a crisis in some sense. But according to the measure of differential capitalization, dominant capital is still in a crisis. It's still consistently, and this goes all the way to September, I think, August or September of this year, is still failing to beat the average. And so that signals to me anyway that is something highly significant, and this is, at least at the highest echelons of the political economy, this does represent something that is potentially novel. Now, I have more to say about why that's so. I was going to talk a bit about monetary and fiscal policy. Why is there systemic fear? I'll just wrap up very quickly. There has been an unprecedented fiscal stimulus, and all the tools of monetary policy have been deployed, especially this first round of quantitative easing. And that has not produced a significant rebound or recovery. It's perhaps staved off a major deflationary spiral, but we have not seen a robust recovery, even though all the tools of monetary and fiscal policy have been deployed. And the fear, I think, especially amongst Bay Street, I've got one of my favorite commentators on Bay Street. He's a bear, but I think he's quite insightful. The fear is that the Federal Reserve is out of policy tools. That's the reason why you have a second round of quantitative easing. It's because the first round failed. Why would investors expect the second round to succeed when the first round did not? And basically, I'll just finish off by saying this. What they're hoping for, this is what investors are hoping for, is that the new round of quantitative easing inflates asset prices, especially stocks and the housing market. What will that do? The inflation of the housing market will make the American consumer feel wealthier, so they'll borrow more money and spend. That is the solution that's the best case scenario. This is what they're hoping for, is just to see more borrowing against a mortgage that people will never be able to afford to pay back, and get spending again. And that's sort of the best case scenario for getting out of this crisis. And that seems to me to be, anyways, certainly by orthodox economic thinking, that's a huge betrayal. No talking about productivity and innovation and so on. They're talking about purposely inflating assets beyond their quote-unquote true value to get the economy going again. And so I think there is something to be said about the idea that there is systemic fear amongst the highest echelons of the business class. Thank you.
Thank you, Jordan. That leaves us about exactly half an hour for questions. So I'll just start. Maybe we should do it one by one because I think that's more effective. Jason, I'll take your question first, and then Herman. Okay, I'll take you second, Herman. Yeah. Go ahead.
Two things.
Is it on mute there? No, it's not.
I'll speak loudly. Two things, Mike. There's some, because you were talking about market shaping and market making. I don't care about Europe. The words struck something in the back of my head. There is talk that the market makers are leaving the options exchange in Chicago. They're not making any money, so the market makers in the exchanges are getting out of the business. Because in one sense, I'm using the buzzwords for a point. The chatter about the high frequency trading is also indicating that possibly external actors are trying to synthesize being a market maker, and the market makers are getting out. So in terms of just using those words and their potential roles, or I'm in adjective land, I'm not talking about something objective, is that you might have some real live stuff going on where the market makers are leaving and the market shapers are coming in actual possible empirical data. Right, from options exchanged and possibly the stock exchanges themselves, because they're also just leaving the business, which on one side, the long-term traders are saying, well, that will clearly create volatility because there's no market maker in the middle, or you might get a sort of synthetic stability, right? Because if the high-frequency trading machines are going back and forth, they might get some stability briefly, like for a good segment, but it's not really stable. Do you know what I?
Yeah.
So it's just just an observation about some adjectives and people making this sort of things, you might be able to see something that's real live to kind of find other adjectives for what you might want to study in terms of policy that might be happening. It's just an adjective to adjective comparison. Does that make any sense?
So you're,
I'm
who's leaving the process? What do you mean by that? Like policymakers are leaving the process once?
Not policymakers. I'm sorry.
I know I was probably a little unclear.
Okay, I'm sorry. I'm talking to in the actual trading infrastructure. I am not talking about political economy. I'm talking about just pure trading.
Financial trading. Yeah.
Market makers are leaving the marketplace because
Okay.
they're being pushed out.
Right.
And so I'm trying to indicate in just an adjective of market maker to market shaper as just conceptual things.
Right.
It's happening as we speak
Right.
in the options exchanges and the stock exchanges.
Right.
So you have a microcosm to compare shaping and market making, how they're fighting with each other
All right. I see.
as a way to sort of now say, hey, could that be something to watch as you now want to ask less microcosmy kinds of questions?
Mhm.
Because it's I know of this thing that's happening. Little birdies have told me this.
Right.
Is
Right.
that-
Right. Yeah. No, that helps. Like, and then you could use that microcosm as kind of a comparative thing with what's happening in the European Union. Is
Yeah,
that?
yes, or to just to test other adjectives, other
Right.
concepts. Oh, look at that. This is
Right. Okay. I see what you're saying. Yeah.
and Jordan, are you aware of like a website in the States called Shadow Stats?
No?
Okay, so one of the things that is going on is a fellow, I think, who was hanging out at the Bureau of Labor Statistics, had been there for years and years and years, left because he just got mad, as the thing that's called CPI is no longer calculated for what the actual algorithms have been changing every year for 20, 30 years. So he provides a service because he's been in that bureaucracy for decades and then he left. He knows how the algorithm ought to be calculated as of when it was important in the 70s, if you see what I mean. So he then goes through all the footnotes, all the details that are published by the American government to actually calculate the CPI as it was initially showed up in the 70s, so that you have the true baseline CPI number that is constant from the actual data inputs, as opposed to the thing that's told you is a number and we call it CPI. So the actual inflation that's going on in the States and what the government announces as the States, they just change how they calculate the number to get a different CPI.
Okay.
So some of the things that you might be wanting to compare, if you're even looking at Canada, is to also explore how the thing you get from the CPI number is fiction.
Okay.
It's fiction to compare against through regimes. You were like, I was looking at your scatter plot. I forget the word that you're trying to say. Well, this is the 70s and
Oh, yes.
this crisis. And so one of the things that's going on, possibly by trying to beat a benchmark, if they're wondering that this particular bond rate is supposed to match inflation expectations, if I may, is that the actual inflation that is reported by the CPI number may not be the benchmark that they're actually losing against.
Okay.
They may be losing against actually a bigger monster.
Okay.
Because the number's much higher, because the government is actually producing a number that isn't the same calculation, it just goes by the same heading.
Okay. I have to look behind these numbers, and it's one of the things Professor Nitzan teaches in the class, is going to the national accounts and seeing how these things are actually constructed, and maybe finding out whether it's sort of whether the logical leaps involved in constructing these figures. My understanding for the Consumer Price Index is that it's basically they take a basket of goods and they price them at different points in time. So the basket has to change because new products are invented. You can't look at the cost of, say, a laptop in 1950, even though it would probably be in the basket today. So I don't exactly know how they compute it, what goes into the basket. I think for core inflation they exclude food and energy, but I'm using the CPI just as a basic measure of prices, but I certainly have not looked into how it's actually changed over time.
Giving you no grief, just wanted to let you know that the shadow stats thing, there's a small following in the States of, oh yeah, that means the government's always lying.
Okay.
But I mean, the shadow stats tells an interesting story that is not being talked about.
I'll look into it. Thank you.
Right, next we have Herman Schwartz.
Good papers. I just want, I have a comment on Jordan's paper, but I just want to say a couple words about shadow stats because it came up. So, shadow stats attracted attention of the elites as well, and there were some hit jobs on it. The most convincing hit job was one that suggested that all the guy was doing was adding a proportional boost to the normal CPI figure, and that boost was constant for every data point. So I would use the shadow stats with maybe as much caution as you use the real stats. And that relates to the second or more important point, which is the quote from this financial journalist, which is to be careful about them too, because it's certainly plausible to interpret what he's saying in the way that you do, which is that the way we're going to get out of this crisis is by encouraging American consumers to take on more debt and spend more. And there's a grain of truth in that. But the other thing that's going on with asset price inflation or home price reflation is in the Nitsan world a power process, and in the normal financial world a crucial accounting process. And the accounting thing here is that if you reflate home values, you restore the value of the assets, the impaired assets on banks' books, and then the banks are no longer bankrupt. So inflation there is meaningful in more than just a demand side function. And then the power process thing is that if you inflate house prices and if you have inflation, you're going to redistribute income from one group to another. And inflation preserves the nominal, holds up the nominal value of the houses, which is what matters on the bank's balance sheets. But what it, of course, does is take money away from people who are the beneficial creditors of those mortgage-backed securities. And those are now largely two groups of people. It's me, through my pension plan, and me as a taxpayer. So it's actually one group of people you can split up in different ways. Yes. So this is also about differential accumulation, right? I mean, this is, I think, the whole point of the analysis of inflation in capitalist power. So the financial journalist, he's a financial journalist. He's actually I would be more distrustful of him than I would of the people at the BLS.
Okay. This fellow's name is David Rosenberg. He's actually the chief economist and strategist for a major investment house. I didn't say that just because I was running out of time, but it's Gluskin and Sheff, one of the biggest in Canada and in North America, I think, as well. I enjoy reading him because, firstly, he's such a bear, and it's so enjoyable to read the pessimists. But I find it so interesting. He says, this market is built entirely on hope. Economic funnels have been thrown out the window, but everyone's crossing their fingers that the Fed can raise asset prices, and that's the recovery. And it just seems to me, I haven't reviewed my economics textbook recently, but that's such a deviation from the real underlying productivity or real underlying value of things. And this is what I take him to be sort of a spokesperson for the investment community. Actually, I don't want to call it a community. It's not a community, but you know what I mean. It's interesting to me.
Right, next is Jonathan.
Jordan raised the question of why we wrote full papers on the crisis and did not mention differential accumulation, and the reason is that we don't write on things we haven't investigated satisfactorily. So we are still in the process of working on it, and it will come in due course. Now, I'd like to clarify a little bit the framework. The idea was already spelled out in 1999 in a paper we gave, I think it was in Washington, which was presented to a very, very large group of people, about three people were in the audience. And the paper was titled, "Will the Merger Wave End in Global Stagflation?" And essentially it was a paraphrasing of the basic hypothesis that you mentioned, that there are two regimes of accumulation, and as long as they operate, they tend to operate in a counter-cyclical fashion. And these are broad regimes. They're not focused on individual firms or sectors. They're focused, in fact, on large societies such as the U.S. and perhaps even at the global level. So in the early 2000s, in a paper called Dominant Capital and the New Wars, and then subsequently in two other papers that are called Cheap War and New Imperialism or New Capitalism, we basically suggested that the merger wave is increasingly, over time, breaking envelopes. And you move from the sector envelope to the national envelope and then to the global envelope, and there's nothing beyond the global envelope. So as you're moving those envelopes from one to the other, you eventually have to decelerate the rate of amalgamation because firms become very large and they have fewer and fewer envelopes to break. So this is an issue of glass ceiling as well. It's a form of glass ceiling, and therefore we speculated in the late 90s and early 2000s that in the future, and I don't know how long the future we were referring to, but in the next 10, 20 or whatever years, crises are going to become increasingly stagflationary because dominant capital is going to be pushed into trying to redistribute income through inflation and therefore through stagflation. And we argue that the conflict in the Middle East can be at least understood in that context, that these conflicts, of course, had many different reasons, but they were quite tolerated by capitalists because there was the expectation that somehow they would raise the price of oil and therefore bring inflation. And for a brief period, it actually succeeded, and inflation started to rise around the second invasion of Iraq. But then we encounter the current crisis, and it's quite obvious from the commentary of various capitalist, say, fund managers, such as PIMCO or central bankers, that they are trying to find ways of boosting inflation, and they say so quite explicitly. So in the latter part of the 2000s, they were trying to persuade themselves that there is no such problem of deflation, that banks can always, central banks can create money at will and they can generate inflation at will. And at that point in time, it was kind of a self-congratulations, don't worry about it, deflation cannot happen. We know we have the printing press and we will prevent it. They started to stop the markets by persuading markets, quote unquote, that this is in fact going to happen, so to try to generate inflationary expectations. And now they're in the second round of what they call quantitative easing, which is essentially trying to print money in order to stop inflation, and they failed. So we are running into this intellectual barrier that they're thinking about inflation as a monetary phenomenon and as something that has to do with central banks and policymakers, and they're completely unable to comprehend the power essence of inflation. Inflation is a rise in prices. It's not the printing of money, and Japan is a case in point. You cannot push in a string. You can print as much money as you want. That does not generate inflation. You have to generate the power process. So I think the line of argument you put here that you can actually correlate the decline of inflation and the possible deflation and kind of negative stagflation, if you like, although there might be a lot of stagnation, is an illustration of differential accumulation potentially breaking down. What I would, though, recommend that when you look at the data in Figure 5, for example, if you can put it up, you look really at the level of differential capitalization, and you do not look you do not look at the rate of change of differential capitalization, because the rate of change of differential capitalization will give you the rate of differential accumulation. Whereas here you're just measuring basically the elemental power of dominant capital. So that is one recommendation. The other recommendation is to realize that the differential accumulation index is a reflection of many different things, one of them possibly inflation, but the other is also mergers and acquisitions. So this is missing. So obviously any correlation will be partial, and you have to account for that. Yeah, that's what I had to say about that. Thanks.
Well, thank you for that. This was approximately 3 weeks of research, and in week number 1, I decided it was a big mistake to enter into it because I had no time and I was totally out of my depth, and I'm completely out of my depth still, and of course I said, or I tried to indicate that I was on very shaky ground because I don't have the sufficient evidence to show what I was saying. But it seemed to me, I'm just restating though, you know, Barry Eichengreen and these people are talking about this crisis mainly in terms of basic measures of depth and velocity and breadth, not in the capitalist power terminology. And you said this is systemic. So to my mind, there should have been some manifestation of this at the level of dominant capital and differential accumulation, and that's exactly what we've seen. And what is unique about this is deflation. It was very slight and very brief. In this, you know, if you look at the Great Depression, of course, in the 1920s and so on, you see massive swings and massive deflation. But in the post-war era, it is unique. And so I thought that was maybe something interesting. And this could have been a 3-minute presentation. I basically just could have summarized everything I just did in 3 minutes and shown you a couple of charts. But anyways, I'm just restating now.
Just before we go to Jace, does anyone else have a question who hasn't spoken yet? We'll go with Fred.
Yeah, question or a couple of issues for Jongchul. You made a point about the Goldsmith notes circulating within the London community. Yeah. Of course, outside of London, the banknotes were not Goldsmith depository notes, but were purely credit bills. Yeah. And so when writers like Scroope talk about the fact that most banknotes are credit notes, it's because he's talking about the fact that most of the notes are outside London by private banks. Yeah. So does that affect your analysis in that way? Because you talk about corporations or large institutions, whereas the banking system in England at that time was very small. I mean, a bank could not be owned by more than 6 people. That was the regulation. They were all private banks, particularly those outside. In Scotland, it was different, as we chatted yesterday about Adam Smith talking about the financial systems in Scotland and England were different, and so capital was more productive in Scotland. So there's that issue about the outside of London and the inside of London. So on the second part, you talked about property, and it's worth probably mentioning, I would feel, Bentham and Mill's position on property, and that there's no property unless legally defined. So no one has any rights unless the law has been passed, and that was ridiculed by many writers, but that was the basic view that dominated England in the 1820s and 30s, and formed the basis for the 1848 Bank Act, which is what's led to most of the banking systems subsequently. So you perhaps need to mention that although property was viewed in Lockean sense, eventually everyone claimed to be Lockeans and then went in exactly the opposite direction. Okay? Yeah.
Yeah, thank you for the second comment. So I will examine this transition from the Lockean to the bank. And for the first question, actually, I'm not quite understand what your question, but
it's not so much a question; it was more an observation. In the you talked about what was going on in London.
yeah,
But what was going on in London was the minority of what was going on in the banking system in England. Most of the financial activity was outside of London, and the bulk of it was purely credit notes. So it wasn't Goldsmith banking. Goldsmith banking was relatively minor and only pertained to London. Outside of London, it was bills of exchange, not depository notes.
yes, after the South Sea bubble, the Bank of England is only chartered banker. It's a corporation who has a monopoly right, privilege to issue the banknote. with the demand clause, with the bearer clause. So outside of London, I'm not quite exactly remember the exact analogy, but outside of London, there were many country banker. They didn't issue the banknotes until the early 19th century. But there's many monies, many funds actually flow into the London because many countrymen, rich countrymen, need to spend time in summer during this time in London during the summer. They deposit their money into the Goldsmiths Banker or Bank of England. So the circulation of a banknote in the community of London is actually contribute to the whole circulation of banknotes in England as a whole. But I'm not quite clear about that. I'm sorry.
All right, we've got only 5 minutes left, so we'll have, maybe if we can have as quick as possible questions and answers from Randall, Jermaine, and then we'll give the last word to Jason as well.
Thank you very much. Those were 3 very good papers. Just as a kind of a follow-on from the point about the provincial banks and the country banks, in some ways, the really interesting question about the period that you're looking at, Jongchul, is really why did all of the money that was accumulating in the provinces outside of London, in fact, begin to flow into London, which was then captured by the goldsmiths? And that's really the interesting story, from my perspective, the kind of the interesting story there. And just to add one more part, I mean, there's not just the way in which there's a kind of a tension between the London-based banks and others. But if you think about, Fred talked about the bills of exchange, I mean, if you look at the circulation of credit money, it has a much longer history than that. And kind of the notion of trust that you're focusing on, in a way, it could be on some accounts much more tightly related, to the Italian bankers and to the German bankers, rather than beginning as you kind of create a kind of disjuncture between the pre-modern and the early modern, when there's a very large period of time between about the 13th and 17th centuries in Italy and in Germany and in continental Europe, where there was a huge flow of credit money going around that displayed exactly some of the same kind of issues that you're trying to locate in London during that time. But those are just observations. I mean, I have kind of 2 other questions, really, which are to Mike and I guess then to Jordan. And I guess the observation first to Mike is that I find it really interesting that you're looking at the legal system as the point of entry through which integration, and the particularly liberal form of integration in Europe, is proceeding. I think that's really interesting in terms of thinking about power as ownership, which is part of what we're doing here, I guess. But one of the peculiar aspects of the legal system versus, say, the market is that the legal system opens itself up precisely because it is a legal system. And this may be mostly only in democracies, but we're talking about the EU here. It opens itself up to an equalized form of access by many different kinds of pressure groups. So the question is, you've portrayed the legal system as a point of access for effectively transnational corporations dominant capital. Could you not also see the legal system operating in reverse as a point of access for those who don't share that particular vision of how to organize society and its property? And if you can think about it in that way, does that throw a wrench into the trajectory that you're outlining? And I think actually a caveat to that. Sorry, I'm going on a little bit. law is one of the big lacuna in political economy. I think we don't recognize the importance and centrality of law and legal frameworks except as a derivative kind of a repository of where power relations are played out. And I sometimes wonder if, in fact, the legal system isn't just a little bit different. With respect to Jordan, just a quick question. I mean, I kind of like your analysis. One of the things you didn't raise about Eichengreen and all the other kind of the army of people who are trying to figure out what on earth went wrong is the role of imbalances, global imbalances. And I could extend that to the operation of the interstate system if you like, but we'll just do it one step at a time. And I'm just wondering, it's not so much, there are some arguments that what happened in Canada was really, it really was a kind of a very minor a representation of where the big action was, but the big action was, in part, not entirely, but in part about imbalances. And until we begin to kind of factor in how these imbalances work, we're not going to understand why the kind of the fear of doing something is going to be overcome. But also, I think we're missing out a very important material part of that picture of what actually did happen between 2005 and 2010.
Okay. Thank you. So we've got about 1 minute left. If you could just keep it as brief as possible.
Can I? Yeah, respond. Actually, it's my first paper about Goldsmith banking is actually refute the two conventional wisdom about the Goldsmith banker's note and the bill of exchange or other credit development of credit instrument. I argue that actually conventionally it is regarded that credit money is originate in Italian city, and also many people believe that credit banknotes evolved from the credit instrument, especially from the bill of exchange. So I reject two wisdom, and then I argue that the institutional scheme of the Goldsmith banking system is very different by nature from the normal credit instrument. It is my argument. So it is the idea of trust built in this argument. Also, why many monies flow into the Goldsmith banking, flow into the reason why many monies flew into the Goldsmith banker in the late 7th century has a political reason, political struggle between the crown and the property owners. So in the paper I describe this political struggle and how this political struggle originate the scheme of trust. It is my argument. So if you're interested, please email me.
All right, Mike, we'll have a quick response from you.
Well, okay. My relatively shaky understanding of this at this point is that if capitalism is understood as embedded within institutions, and if coordinated capitalism is particularly strong in terms of welfare state consolidation, in terms of collective bargaining regimes within Germany, ownership schemes like corporate governance is very much a different thing in Germany than it is in the United Kingdom. Those are much more. It's much harder to use legal recourse to consolidate that type of institutional configuration, and I think it's much more amenable to the legal sphere to dismantle that. I think it's much easier to find holes and to use legislation that is designed for transnational capital flows. It's easy for domestic actors to use that legislation within the domestic sphere in a way that it wasn't designed to do. It wasn't meant for that. So there's your distinction between the political and the legal. I think coordinated capitalism is a much more political rather than a legal phenomenon, and so I guess that's my short answer to that.
All right, Jordan.
Randall, thank you for the point. I still am sort of at the beginning of a research project, at the very beginning, but that would be something I definitely have to consider because Canada is such a small player. So I'll hopefully be looking at that in the future. Thank you, though.
All right, so we'll break now for lunch, but just want to thank the presenters for some excellent presentations. And we start again at 1:30.